Thank you so much, ladies and gentlemen, and welcome again to another episode or another video of our financial intelligence classes. And in our today's video, ladies and gentlemen, we shall be talking about investment checklists. Investment checklists. Investment checklist, ladies and gentlemen, very important and very informative, and it's very sensitive when it comes to investments and businesses. So ladies and gentlemen, just like other checklists that you normally have in your life, there are people who normally have checklists before they date. There are people who normally have checklists before they marry, on each and every person based on the partners that are going to marry or date. You also have checklists, for example, when you want to relocate in another house or a different place, you need to check on if that place is having some security and so on and so on. Even when you want to relocate to another house, you see the convenience of that house, whether there is water, there is electricity, there is security and such. Those are the kind of checklists that we are talking about. But in this particular case, ladies and gentlemen, we shall be confining ourselves towards investments only. We shall be confined towards investment on. And when we talk about checklist in this particular video, as we talk right now, we are talking about checklists to do with investments. And what I mean by checklist to do with investment or investment checklist is actually what you are supposed to check before you engage yourself in any kind of an investment. Before you say and you settle that your mind that this is the investment that I'm going to do, this is the money market fund that I'm going to invest my money, or this is the company that I'm going to buy my stocks, or this is the platform that I'm going to do my investment. What are the things that you are supposed to check before you make up your mind at that particular moment? Because this is where people go wrong, and then later you find out because you did not do a comprehensive research and came up with a very good checklist that is going to tell you whether it's a viable or not viable investment, and then you find out that you actually lost the game. So ladies and gentlemen, stick with me in this particular video so that at the end of this particular video you can be able to learn something very important that you didn't know as far as investments are concerned. Now, ladies and gentlemen, before I continue, this is another reason that you should stay subscribed in this particular channel. If you have not subscribed, make sure that you hit the notification bells. Make sure that you subscribe to this channel. You can also share this video to your friends so that we can have a lot of people being educated. And if you feel that you want to say something about this particular video, you can put your comment on the comment section so that we can interact there and see how we can help each other. So ladies and gentlemen, just like the old times, I shall have my notes here. So when you see me turning from one side to the other, I'm just confirming on what I've written here so that I may not forget anything that I've prepared for you. So ladies and gentlemen, again, thank you so much and welcome to this video. Let me put the title here: investment checklists. Checklists. Hope I've written it correctly. That is investment checklist. Now, without wasting time, ladies and gentlemen, I'm going direct to my point number one on what you are going to check. And before you do any investment, you need to ask yourself, do I understand it? The first one is, do I understand it? Understand it. Do I understand it? That is a question that you're supposed to ask yourself anytime that you want to engage yourself in a certain investment. Now, I want to get into money market funds. Now, do I know how money market funds work? I want to buy stocks, or I want to trade in Nairobi Securities Exchange. How is it done? I want to buy shares of a company. First of all, what are shares? What is the meaning of shares? So those are the kind of questions that you need to ask yourself. How do money market funds work? Oh, I hear people that normally buy treasury bonds and treasury bills in with Central Bank of Kenya. How do they work? How do they help? What are the interest rates? And how is the investment duration, and so on and so, such kind of questions. Ladies and gentlemen, listen here very carefully. If you don't know, kindly abstain from that particular investment. If you don't know how money market funds work, just obtain from it, because at the end of this video, I'm going to tell you why you should abstain from that particular investment. If you don't have information about it, just don't do it until you get the correct research, until you do a comprehensive research about it, so that you can know what you are getting yourself into. So anytime there is a mistake at the middle of the investment, you knew, or you can know the risks that are going to be associated with that particular investment. So ladies and gentlemen, the first question is to ask yourself, do I understand it? Do you know how money market funds work? Do you know what are shares? Do you know what are stocks? Do you know what are treasury bills and bonds? Do you know what is cryptocurrency? Because right now, if you look at, there is a lot of information going on online about young people now want to join cryptocurrencies, about forex. Forex is another investment that you can do. Those online platforms whereby you trade forex, that is bitcoins, metals and such. Do you know what are they? Do you know how they work? What are the risks associated to them? All right, such kind of an information is what you are supposed to research first. And if you see that you go to the internet and then you feel like you're not still satisfied with the information that you obtained from the internet, and you feel that you still want to obtain more information about a certain investment, for example, a money market fund account, that is where a professional financial advisor comes in. Those people who have done comprehensive research previously, like for example, John here has done comprehensive research to do with money market funds and knows exactly how they work and knows the risks that are associated to money market funds and the mitigations that you can put on those particular investment. So ladies and gentlemen, the first question is, do I understand how that investment work? Now, the second question that you're supposed to ask yourself, or the second thing that you're supposed to check on your checklist before you engage yourself in any kind of an investment, is, what is the risk level? What is the risk level? So ladies and gentlemen, you need to ask yourself, what is the risk level associated in that particular investment? You need to ask yourself, how much can I afford to lose? That is a question that I normally tell investors to ask themselves. How much can you afford to lose? For example, if you decide to invest in a money market fund account, ask yourself, in this money market fund account, this is a risk versus return. Now, how much can I be able to afford to lose? Even if it's when it comes to stocks, when it comes to treasury bills and bonds, ask yourself, how much can you afford to lose? For example, I'm just going to give you a very simple scenario here. For example, if, for example, now, I'm not going to say income, but just let me put it in layman's language so that everybody can understand. If you say, out of 100 shillings you earn, you can be able to risk 10 shillings. Yes, out of 100 shillings you earn, you can be able to risk 10 shillings. This is a risk-averse person. Now, that one is a risk-averse person. Another person will say, out of 100 shillings I earn, I can be able to risk like how much? Let's say 40 shillings. Or let's say even 50. Out of 100 shillings I earn, I can be able to afford, or I am willing to risk, or whatever you understand, I'm willing to risk 50 shillings. That is a risk neutral person. Now, you need to understand where you lie on this category. And then that person can say, out of 100 shillings that I earn, in every 100 shillings that I earn, I can be able to risk how much? Let's say 70 or to 80 shillings. Out of 100 shillings, I can be able to risk 80 shillings. This one is a risk taker. We call them risk takers. Risk takers. These are people who like taking risk. And in most cases, they win the game because the higher the risk, the higher the return. But in most cases, they can lose ruthlessly. But now, it depends with you. Where do you lie on these three categories? Are you a risk-averse person? This person who doesn't like, and in most cases, you are going to find a lot of people here. This is where you are going. This is the category of people who are going to invest with money market funds, because money market funds are low risk investments, whereby you have a low return, like 10% return compounding, and you are comfortable with it. All right. But someone else who is a risk neutral person is going to tell you, oh, that money market fund and those kind of businesses or investments that you normally do, those returns are very low. I cannot put my 1 million there and I'm just there sitting and waiting for for me to earn 20,000 per month. No, this one, let me go for something solid that I'm going to earn more money. Let me put a business somewhere. These are now people you are going to find themselves in. You are going to find them in probably businesses and so on and so on. Risk neutral people. All right. Now look at this guy. This guy is out of 100 shillings that this guy is earning, can be able to risk or can be able to lose or risks 80 shillings. This is a risk taker. These are risk takers. These are people who don't think twice. Whenever they see an opportunity or an investment, they go for it without thinking. Bora wameona pesa, there is a possibility of multiplying here. 3/4 of this money, it might come back as half. All right. So ladies and gentlemen, you need to understand your category. Ask yourself, just you self-awareness. Ask yourself, am I a risk-averse person? Do I like taking risk? Am I a risk-neutral person? To what extent can I be able to take the risk? What amount am I willing to lose? Out of these 100,000, how much can I be able to risk? There is a person who can risk 10,000. Another one here can risk 50,000. And another one here can risk 80,000 without thinking, without a blink of an eye. So, ladies and gentlemen, it's upon you to evaluate yourself, to ask, to do what we call self-awareness, and of course, ask yourself, which category do you fall in these three? And once you understand yourself based on your own personal capability, then you can be able to answer this question: what is the risk level? And then when you answer that particular question, you can be able to do that particular investment. Because if you find yourself here, then it means you belong to the categories of treasury bonds, treasury bills, money market funds, and low risk investments. All right. If you find yourself here or here, then it means that you are a business person, or those investments that have high risk. You see those investments that I'm going to have that are going to have high risk. For example, even Forex. Forex has high risk, and therefore these are people that you are going to find even in those extreme investments that I'm going to have high risk, but in return they have high returns. But in most cases, you must be very careful. All right. So, ladies and gentlemen, that was my point number 2. And now let's go to my point number 3. I hope you are getting something out of it. Remember, number 1 was, do I understand it? Then, what is the risk level? Now, my point number 3 is, what is the expected return? What is the expected return? So, ladies and gentlemen, there is no way that you are going to put your money in an investment that is not going to have any return. No, this is part of the consideration. This is the part of the checklist. Is the return too low or too high? When the return is too low, some returns can even be less than the inflation rate. For example, if the inflation rate is 4%, 4 to 5%, and then the return is actually 6%, another one is 5%, another one is 3%. This kind of a return is not, it's not that competitive. You need to invest your money somewhere else, whereby at least you can say even twice the inflation rate. At least when the inflation hits, then at least the half of your investment is secured and you can be able to maintain your capital. So, ladies and gentlemen, what is the expected return out of that investment? When you invest in a money market fund, you are assured that there is a 10% return, which is compounding. there is a 10% return, which is compound. But if you have realized, I like giving examples with money market funds because it's one of the investments which is going to low risk investment, but has the best features. For example, compounding, which is that investment that you can say that has compounding, that interest that was earned yesterday is part of the principle to be compounded today. And therefore, that's when you find yourself that you are having actually your money is multiplying much faster as compared to other investment. Now, in this particular question, this is where you ask yourself, if I have investment A, this is where you ask yourself, if I have investment A and investment B, investment A is giving me a return of 20%. Investment B is giving me a return of 10%. Investment C is giving me a return of, let's say, 30%. Which investment can I go for? You see now, this is where now you need to analyze several investments. So when it comes to checklist, you are not only dealing with one investment, you are dealing with several investments. You have investment A, money market fund. You have investment B, treasury bonds. You have investment C, investment in biological assets. You have investment D, businesses that does not require your presence. You have investment E, and so on and so on. The list continues. You need to have several of them, and then you are going to appraise each and every of them and see what is the return, which gives a very competitive return. And you are going to find out that the one is going to give a competitive return, then they have a higher risk. Then ask yourself, go back to your checklist. What is the risk level, and am I willing to take that particular risk? So ladies and gentlemen, again, what is the expected return? You need to compare different investments and see which one you can undertake based on the returns that they are giving you. And remember, risk and return goes hand in hand. And that's why this point number 2 and point number 3, they are close to each other. Evaluate yourself here and go back there and see whether you are willing. If you're not willing to take that investment that has high risk, then you should go for that investment that has low return, low risk. All right. Thank you so much. Then let's go to our point number 4. Our point number 4, ladies and gentlemen, time horizon. Very important. A lot of people miss this particular point, and then you find yourself that you messed yourself up because you did not evaluate yourself well. Time horizon. And when we talk about time horizon, there are 3 things that you're supposed to note here. 3 things that you're supposed to note. When we talk about time horizon, is really we are talking about investment period. Investment period or purpose. Investment period or purpose. And when we talk about time horizon or investment period or purpose, we are talking about 3 things. Number 1 is short-term investments. We talk about short-term investments. We talk about middle-term investment, and we talk about long-term investment. Now ask yourself, what is the purpose or what is the investment period? Is the purpose of your investment for short-term obligations, or for long-term purpose, or middle-term purpose? For example, if I decided to invest in a money market fund, and my purpose of this investment is to have financial freedom, then the moment you mention financial freedom, then it becomes a long-term purpose. Because financial freedom, I'm not going to start investing in a money market fund today, and then 2 years later I'm already having some financial freedom. Yes, I could be having, but there is that level of financial freedom that you are looking for. So when we ask yourself, what is the purpose in terms of investment period, is the purpose of that invest. For example, if you'd say that I want to save for 1.5 years so that I can be able to open a business, therefore you are going to put your money in an investment account of money market fund account purposely for opening a business. So that one is a short-term goal. So the goal of investment is short-term. You get what I'm saying? Then when you decide that you are going to put your money in an investment account for middle term, then you say that Once I have accumulated that particular money, I'm now going to do something solid. So it even depends on the purpose at the end of the investment period. What is the purpose that you want to accomplish, or what is the goal that you want to accomplish? If it's starting a small business, it can be 1 year. That is a short-term investment. All right. Now, if it's starting a mid-sized business, it can be 2 years or 3 years. That is a middle-term investment. Now, when it comes to long-term investments, the purpose is you want financial freedom, or you want some passive income that will be generated in perpetuity. You get what I'm saying? Some passive income that will be generated in perpetuity without stopping. So therefore, I want to accumulate funds in this particular, for example, those people who do, if you start buying stocks or buying shares of a company, and you say, the purpose of this particular investment is to earn dividends in perpetuity. So you don't plan to stop anytime soon. So you are doing that investment in long-term basis. So you need to ask yourself, what is the time horizon? Very important. If it's for short term, then you can do money market funds. You can save there for 1 year, withdraw your money, then fulfill your purpose. It's for middle term, you can also do money market funds. Save their money for 2 years, 3 years, then withdraw your money, do what you wanted to do. If it's for long term, consider treasury bonds of the government that are going to give you like at least 14%, 15 years, 18 years, even 20 years. That is a long-term investment, such kind of an investment. That is how you are going to appraise them and see which one fits best. All right. If it's for again long term, you can do company shares. You can buy shares of Safaricom for long term, and then you are going to enjoy dividends in perpetuity until you decide probably you want to stop this, or probably if you even die, there is someone to take over that particular investment. So ladies and gentlemen, time horizon is another checklist that you need to check when it comes to that investment. Now, let's move to our point number 5. This is getting very interesting, ladies and gentlemen. I hope you're moving together with me. My point number 5, ladies and gentlemen, touches on liquidity. Liquidity, very important. Liquidity. And those people who doesn't know what is the meaning of liquidity, it is the... Now, how do I mention this in layman's language so that a lot of people can understand? Liquidity is whereby you can be able to fulfill your short-term financial obligations. For example, rent, food, putting food on the table, transport. If you can do all that, or you can be able to finance all that, you can be able to pay for your rent, pay for your food, pay for your transport. You can be able to pay for your daily needs. That is what we call liquidity. Being able to fulfill your short-term financial obligations when they fall due. That is the liquidity. Now, when we talk about liquidity in investment perspective, is asking yourself, if you needed your money back that you had invested in that particular account, how fast can you access it? That is liquidity. How fast can you access it? And for example, when I mention in terms of money market fund, you know, money market funds are very interesting. They are compounding. You are in full control of your account because you can deposit anytime and withdraw anytime. So we say money markets are very liquid because, for example, look at the case of ZD Money Market Fund of Safaricom. If I put 100,000 today, and after 1 week, there is an opportunity there, and I withdraw that money immediately, it's going to reflect in my M-Pesa balance there with immediate effect. So I don't have to wait for days or weeks or doing. I don't have to struggle retrieving that amount to my account. So ladies and gentlemen, liquidity is how fast can you be able to access. And when you are assessing this, you need to ask yourself, do I require this money anytime soon? Do I require this money anytime soon? There are people who invest rent, and then you decide that you are going to buy shares with money that you're supposed to pay rent. You see, investing money zinaitangwa misplaced opportunities or something like that. So you are investing the wrong money. Okay, the investment is okay, but you are using the wrong money. Buying shares of a company is okay, but you are using the wrong money. The wrong money was meant for rent, but why use money for rent to buy shares? So ladies and gentlemen, that is why you are supposed to, that's why I said that you need to come up with a budget every time you earn, so that you can know, now this is the amount of money that I have put aside for investment purposes. How much goes to long-term investments? How much goes to short-term investments? How much goes to my middle-term investments? So that if you normally buy some shares each and every month, you say that there is no way that you are going to stay like this. Oh, I normally buy shares of 1,000 or 5,000. I've put a lot of money and cannot be able to retrieve that, simply because you have an opportunity here. So make sure that you invest amount that you don't need in long-term investments. Those amounts that you feel like you may need time soon, probably after 1 year or 1.5, put them in a liquid investment. For example, money market funds, treasury bills, the 90 days treasury bills, the 165 days treasury bills, or 365 days treasury bills. You can put them, you can use such investment for long-term, for short-term investments, to make sure that there is some liquidity. And I prefer money market funds because they are going to compound your money. So it will always be my best. So ladies and gentlemen, let's go to my point number 6. My point number 6, let's talk about diversification. Diversification. And diversification, I think I have put this one in so many videos that I've created in this particular channel of YouTube. And I say diversification, there are 3 things that you're supposed to check. If, first of all, before I mention those 3 things, this is where you ask yourself, does that investment give you room to diversify the risk? Does that investment give you room to diversify the risk? For example, when it comes to money market fund, can you be able to diversify the risks in such a way that you can put money in several money market funds? You can invest money market fund A, money market fund B, money market fund C. So that one is a good investment. So you can be able to diversify. Does that investment give you room to diversify the risk? Because when you talk about diversification, is risk diversification. And we have talked about 3 types of diversification. Number 1 is asset-based diversification. This is where you invest in different assets. Investment in financial instruments, investment in biological assets, investment in other types of assets, the buildings and so on and so on. Now there is sector diversification in different sectors. For example, health sector. You go to finance sector and then you buy shares of a company that is dealing with technology, a company that is dealing with health, and so on and so on. The other one is geographical diversification. You can even say that I'm going to buy shares of a company that is in US, or a company that is in China, all right, or a company that is somewhere else, just to make sure that you have put some geographical diversification. So ladies and gentlemen, that is another checklist. Does that investment give you room to diversify the risk? All right. Now let's go to my point number 7, ladies and gentlemen. My point number 7 on this, let's talk about fees and taxes. Fees and taxes. Now, when you talk about fees and taxes, for example, I'm just going to use a very simple scenario here. Look at the case of money market funds. When you transact from probably your M-Pesa to your money market fund account, you are going to incur some money. Those are fees. Now, if you look at money market funds again, there is that management fee of 2%. Some of them are going to charge 3%, 5%, depending on the fund manager. Mansa X, I think they normally charge 5%, but they have a high return. So such kind of things that you have to check. Again, look at the taxation. Money market funds are going to have a withholding tax of 15% of the interest earned. So if you don't know that, and then once you have made some interest or some profits, and then when you claim the profits and they come less than what you had seen on the screen or your account, you start making noise. Oh, niliona nimetengeneza 240 and then now I have received 150. Now, because you did not capture the aspect of fees, they have deducted their fees, they have deducted some with some taxes. So ladies and gentlemen, I told you each and every income in Kenya, it's going to be taxable, except those incomes that have been exempted from taxation. So ladies and gentlemen, you have to check the fees and taxes. There are some investments that are going to have a lot of taxes. There are some investments that are going to have a lot of fees. Look at when you decide to buy shares of a company, you are going to pay a broker. There is brokerage fees. You are going to have that structured brokerage fee. They are going to tell you that we are going to charge you for this, do custom duties, do what. There is, and the brokerage fee is going to add up, for example, let's say 5 shillings per transaction or 2.75 shillings per transaction. All right. So every time you do a transaction, when you are trading or putting or buying shares of a company, or probably you are doing live trading, there is a brokerage fee of a certain amount. Then when you make a profit out of that transaction, if you make a profit, you are going to be taxed on the same. So ladies and gentlemen, look at those investments that are going to be exaggerated, and some of them may have hidden costs that you may not realize, but you just have to make sure that you have asked enough information about it. So ladies and gentlemen, my point number 7 is about fees and taxes. Now let me move to my point number 8. On my point number 8, based on the investment checklist or things that you're supposed to check before you engage yourself in any kind of an investment, let's talk about who owns or who is behind it. This question you're supposed to ask yourself: who is behind it? Who is behind it? Now that you have chosen that particular investment, who owns that particular investment? Who is behind it? There are people who are, I don't know what's the problem with people. And that's when you start claiming that you have lost money, you have been conned, or G1, 2, 3, because you did not take your time to identify or to find out who owns the business, who owns the investment, ladies and gentlemen. Now, in most money market funds, we normally say, I'm going to give examples with money market funds, because those are the investment that at least a lot of people know. In any investment, for example, a money market fund account, we call them fund managers. And fund managers, before they do business, they are going to be regulated by Capital Markets Authority. So who is behind it, or who owns it? It's your responsibility to find out who is the owner of that particular investment. For example, these online schemes that I normally see, and then if you ask someone, now you're trusting people, you give them like 30,000, and then they tell you that they are going to give you an interest of 10% daily. If you multiply that one is almost 300% in a month. And then you ask that person, do you know the people behind this particular investment? Have you done a comprehensive research on this particular investment? And that's why you see people pumping money, because 10% daily, that's a lot of money. 300% per month, that's a lot of money. And then someone puts 1 million there. Then after 1 month, the whole system collapses and you lose a lot of money, because you did not find out, is that investment viable? Did you do some visibility study before you put money there? So ladies and gentlemen, who owns the business or who owns the investment is another thing that and this one is very important, is very sensitive, because a lot of people has been conned because of failure to do due diligence when it comes to investment. So ladies and gentlemen, who owns the business should be your first question before you even ask yourself all the other questions that you have put them on the whiteboard. Who owns the business? Are they regulated? What are the policies? What are people saying about that particular company? All right. So ladies and gentlemen, that is very, very important. Now, on my point number 9, we are talking about the exit strategy. On my point number 9, we talk about the exit strategy. Now, when you are doing an investment, you need to ask yourself, I have put some money in a money market fund. You need to ask yourself, what When is the right time to exit the market? When is the right time to cash out your money? For example, money market fund interest rates have gone down recently. You have noticed that. Ask yourself, is it the right time to withdraw your money? Or what is the meaning? Have you done a comprehensive research on why the interest rates of money market funds are going down? And is it a reason enough to withdraw your money from money markets? Those are the kind of questions. Or you are just listening to the crowd and the peer pressure and what people, hey, money market funds here, and then you go and remove everything, and then in the next minute you don't know where to put your money, where you can earn some interest. So, ladies and gentlemen, again, exit strategy. Ask yourself, when is the right time to cash out? Where do you need to cash out money? If you have bought shares of a company and the company is seriously collapsing, the company is seriously going down, do you stay there and just and you just watch it going down, or you are going to sell those shares of that particular company so that you can even redeem what you are redeeming at a loss? Because of course, definitely you are going to make some loss there. It's not guaranteed that you are going to have the whole amount. So exit strategy, even in money market funds, when you need to identify the red flags associated with that particular fund manager. You need to identify the red flags associated with that kind of an investment so that you can know the right time to cash out your money. Even when in banks, when you hear there is some red flags in that particular bank, you remove your money immediately. When you hear there is some red flags in that particular money market fund or fund manager, you remove your money immediately. You don't want to risk the money or the effort that you have put towards acquiring that particular money. So, ladies and gentlemen, exit strategy is, and here when it comes to exit strategy, is always make sure that your ears are like this. Like when it comes to online, what people are saying, even you on your own, doing your own research without, because there are some people just like, just talking with no material information. Mtu hata hana kitu ya kusema, but you just want to talk so that people can hear you. So, ladies and gentlemen, exit strategy is very important. And my last point, ladies and gentlemen, my point number 10 on investment checklists, or what you are supposed to check before you engage yourself in any kind of an investment, is emotional check. Emotional check. Emotional check. And when we talk about emotional check, we can also stroke a gut check, or now when you talk about emotional check, just like the word suggests, emotions. Ask yourself, are you in that particular investment because of peer pressure, because of something that people are saying? Look at now the cryptocurrency world, and today's generation is one. Cryptocurrency, Forex, and this generation, Gen Z, that is one thing. Gen Zs are talking about Forex, Gen Zs are talking about cryptocurrency. And it is everywhere in social media, because you can see people flexing there. You can see people driving cars. You can see people living a lavish life, and so on and so on. And you are there, you are 50,000, and now you want to get into Forex. You don't know anything. You have pressure inside you. Something is driving you crazy. You want this money. You want to become a millionaire. You are looking for this person day and night so that they can teach you on how to do Forex, but you don't know the risks associated. Because inside you, you are feeling, you have what we call, there is something called FOMO. Fear of missing out. FOMO, fear of missing out. Like you see people you are on the same generation or your age mates, they are making it, they are doing Forex, they are doing cryptocurrency, and they are making a lot of money. And because you fear that you are being left out in that particular generation, or you feel that you are being left out at that particular moment, you also want to try. And then you take unnecessary risks to do it, and you don't know whether it's legit or not. So you are driven by emotions, but not strategy. You need to be wise other than being otherwise. So, ladies and gentlemen, emotional check. Be wise other than being otherwise. FOMO. fear of missing out. Ask yourself, because if you go to an investment with emotions, in most cases you are most likely to fail. In most cases you are most likely to lose that particular amount. So ladies and gentlemen, emotional check. Ask yourself, are you driven by emotions, or is it out of personal will, or is it because you have a strategy of investment? And I would prefer you having a strategy without listening to anyone. You have sat down, you have analyzed, you have come up with points, and you know, now if I follow this path, it's going to lead me there. I don't know what, I don't care what people say. I don't care what the forces say, but I am going to follow my path and it's going to lead me there. That is an investment strategy that I'm talking about. So ladies and gentlemen, thank you so much. That is my points based on the investment checklist. Ladies and gentlemen, that is a lot of information. 10 points that you're supposed to check before you engage yourself in any kind of an investment. Just to go them through very fast. Do I understand it? What is the risk level? What is the expected return? Time horizon, investment period, or the purpose or the goal? Liquidity, diversification, fees and taxes, who is behind it, exit strategy, and emotional check, or what we call fear of missing out. Ladies and gentlemen, if you're seeing me for the first time, my name is Sir John Mweri. I'm a professional accountant with ex-FinOp accountancy and insurance consultancy, and this is what we normally do. Come here, teach the society about the financial literacy and financial education, so that at least we can make sure that you have perfect financial paths in our life. So ladies and gentlemen, if you have not subscribed to this particular channel, make sure you subscribe. Hit the notification bell so that anytime I upload a video, you're the first person to get it. And at the same time, ladies and gentlemen, you can give me a like on this particular video. Make sure you share to your friends. And lastly, if you feel that you want to say something about this particular video, you can put it on the comment section. Thank you so much, ladies and gentlemen, for watching. Have a nice time. That was my time. See you on the next.